Oil prices sliding after President Trump told reporters that the protester killings in Iran have stopped. That's according to Bloomberg. Oil was initially climbing in today's trade, touching the highest level since October amid the unrest in the country. Joining me now on this, we've got Rebecca Babin, CBIC Private Wealth Senior Energy Trader. Rebecca, it is great to see you. So on the oil markets, Rebecca, you call this a repricing of geopolitical risk. You emphasize Venezuela and Iran. Two very different market reactions, you say. Maybe start there, Rebecca. Explain that for us. What do you mean by that?
So the initial reaction to what happened in Venezuela from the oil market was to reprice additional supply eventually coming back onto the market. It was a risk that we would see accelerating investment in the country and that would actually press crude lower. So although there was an event there that created uncertainty, the market kind of looked through what could have been an initial supply disruption of 200,000 to 300,000 barrels a day and looked out into the long term of what that would mean. In Iran, it's a very different picture. We're looking at uncertainty that could impact a significant amount of supply in the very short term should things escalate. They produce around 3.2 million barrels a day, which is significant relative to Venezuela, which was producing 900,000 barrels a day. And the impact in the short term would very likely be a disruption as opposed to an acceleration of supply. So although the events both created this massive headline bonanza, the reaction from the oil market was to see downside in crude due to Venezuela, while looking at Iran seeing the upside. So it's a very bifurcated response to the two events.
With Iran, Rebecca, despite all the headlines, why, in your opinion, has the reaction been, relatively contained?
It's a great question. And the question I get asked most is not, why is crude rallying due to Iran? It's why is crude not higher based on what's happening? And there's a couple really good reasons for this. And the first and foremost is we are set up right now in a market that is really well supplied. We're expecting inventory builds of 2.5 to maybe 3 million barrels a day in the first quarter of 2026. This is a significant buffer against potential supply loss. Now, does it actually stop a knee-jerk reaction if things escalate and we see infrastructure impacted in Iran? Not initially, but over like a 1-2 month period, that supply is going to provide a buffer. The second reason is OPEC still has spare capacity. They would like to be bringing back barrels that they are holding off the market if given the opportunity, which is another buffer. And the third reason is that really impacting energy infrastructure in Iran is nobody's first choice. The U.S. doesn't want to see crude oil prices higher, and frankly, Iran does not want to see supply impacted either, because that's their main source of revenue and impacts their biggest customer, that is China, who they need as an ally. So those three things packaged together really have offered crude a little bit of a buffer to an extreme or outsized rally that some would have thought would have occurred with these types of events.
So you've got that buffer, Rebecca. What then, though, could create this more material spike in oil? What would you be watching for?
So I think the first thing you would watch for is that the energy infrastructure in Iran is a military target, either from outside sources or internally. If the IRGC, which currently runs a lot of the energy kind of output there, turns against the country and decides to walk off or strike, join the protests, or is forced to potentially harm the energy infrastructure based on the pressure that's being applied to them, that is where you would see a very outsized reaction in crude, because that could be a long-term impact where the infrastructure is impacted. You get this longer-term impact that can't be resolved quickly. People will reference the Strait of Hormuz as a potential risk. I see that as an extremely low probability. I don't think Iran will, as a retaliation to something that the U.S. or Israel does, I don't think they will try to close the Strait of Hormuz. It hurts China, their biggest customer, and it would cause a significant global reaction. And I just don't think that that's something we should put in as a high probability. I know it's been referenced kind of on the media. I would say that the infrastructure risks are higher, and that's what drives crude into the 80s in Brent and TI.
Another story I want your take on, Rebecca, is this interesting sort of tension playing out in Washington. And I'm just curious to get your thoughts on how President Trump talking about he wants lower oil prices because he believes correctly, hey, that's good news for consumers. That's good news for Rebecca and Josh. But at the same time, Rebecca, of course, that could complicate the economics for big oil. And I'm just curious how you're thinking through that dynamic.
It's a great question, and it's a dynamic that's kind of been batted around now for several years. And the key here is producers in the U.S. are not going to produce oil at losses. So their choices, no matter how much political pressure is applied to them, they are public companies that need to serve their shareholders. They've become capital efficient. They have much less leverage, and they're very disciplined on production growth right now. They're going to make decisions based on economics, not necessarily entirely on politics. Now, there is a political element that can influence some of their choices, and we'll likely see that play out in Venezuela in particular. But at the end of the day, their big decisions on how much they produce are going to be driven more about where they are able to generate profits. And at $50 a barrel in WTI, it's very difficult for many of the producers to make a meaningful profit. So I don't think you see producers stepping up to increase production at those prices. That's not to say the rhetoric won't continue, but I do think if we look through and we look at the motivation, the driver is not going to be politically motivated.
Finally, Rebecca, I'll just get you out here on this. Let's get a number on here. I got WTI at 60. Your clients ask you, Rebecca, they say, okay, Rebecca, what do we think? Where is that headed? Near intermediate term? You tell them what, Rebecca?
So I'd tell them right now, if you were going to say how difficult it is to trade crude oil and you're using a skiing analogy, it's a double black diamond. So unless you're ready to ski a double black diamond, maybe you don't make a bet in crude right now and you wait and see how things play out geopolitically. Besides that, if we take away that kind of element, I'd say that the risk right now is that we drift lower. We are fundamentally oversupplied in the first quarter. Positioning, which was extremely short, has been mostly neutralized with this most recent rally. So I see the market settling in a place of around 55 to 60 WTI. That doesn't mean we couldn't get knee-jerk reactions lower or higher from there, but I would advise that unless you have a high degree of risk tolerance, that right now might not be the time to make those kind of trades. You need more information on geopolitics because the volatility, as we saw today with a 4% high to low move, is not for the faint of heart.
Rebecca, always so good to have you on the show. Thank you.
Thank you.